After 7 years of testing hundreds of strategies, patterns, and concepts, I only now use these 5 concepts. And the first one is something I use on every single trade. Let's start. Now, why we only focus on 5 concepts, or why is my main approach now is focusing on 5 concepts? It's actually after 7 years and thousands of trades that I've taken, I come to a realization that complexity makes you no money. So if you're focusing on something that is complex, that is not simple and not repeatable, you're mostly not going to make money. And these 5 concepts is 95% of my strategy. And I'm going to count them from 5 to 1. Now, the ranking is based on how much I rely on each concept. So if you notice here, this is the first 1, 2, and then concept 5. The higher the percentage, the more every trade depends on it. That means concept number 1, I have 100% percentage here. So what does that mean? That means concept number 1, I'm gonna take every trade based on it. So that means there is no trade that I take without, relying on this concept. Now, number 5, 20% of the trades that I take actually rely on this. That does not mean it's bad. It means that it's something that I can actually take another concept instead, or I can sometime ignore. However, number 1 is something I'll apply to every possible trade that I take. Concept number 5 is fair value gap. Now, fair value gap in simple terms, and most of you already have an idea about it, a lot of people actually do, it's a small gap left when price moves too quickly, and it shows that trading was not balanced there. So there was a lot of buying, but less selling, and the opposite. Price sometimes come back to fill part of the fair value gap. Now, why it happens? A lot of different reasons. Most of them comes from news or events, large orders hitting the market, and emotional reactions from traders. And sometimes it's simply a normal market mechanics. It just price going up, but this wick here not touching this wick. That means we have an imbalance. So what is an imbalance? It's when the wick of the highest wick of the first candle not overlapping with the low of the third candle, and the opposite is also true here. So a fair value gap is simply a 3 candle pattern. Now, what I will do for each is show you what is this concept in simple terms and how I use it. Now, when it comes to fair value gaps, you can actually trade it in 2 different ways, or it can be used in 2 different ways. The first one is trade into the gap, which means that price drawn back to fill. That means price is going up, okay, and then we are stopping here, we have a gap here. That means we are trading from here to the gap. So we're going into the gap, which means trading into the gap. The other way of trading it is having this gap and we trade out of the gap. That means we come to the gap and we trade out of the gap, which means, in other words, reaction after the fill. Now, when it comes to fair value gaps, these are 2 different ways that I look at it, and I'm going to go in details on the examples. You could actually build a complete trading plan using fair value gaps. So if you think, and I got this question sometimes, they ask me, can I trade only based on fair value gaps? And the answer is yes. You can actually make a full trading plan based on fair value gaps, because it can be used for entries, for confirmation, for direction, all of the things that a trading plan consists of. It can be found on fair value gaps, and that's why you can actually have a complete trading plan using it. Before we continue, I've taken everything I've learned over the past 7 years and put it all into one place, Edge School. Inside you'll find structured courses including the exact strategy I use every day, the Edge model. These are some of the trades that I do share before happening and I did take with my community members. You're welcome to join if you want to make the real change in your trading. Let's continue. Now, if you want to learn more about fair value gaps and have a trading plan based on it, also using liquidity, you can watch this video, which is the Ultimate ICT and Smart Money Concepts course. I did go over some of the concepts that are necessary on ICT and Smart Money Concepts, as well as some strategies. And one of these is the fair value gap and liquidity model. So make sure to watch this video in order to get an idea about this specific model, which in my opinion is the best ICT model you can actually focus on and trade. So my uses of fair value gaps, I don't use it a lot, only on some specific patterns that I actually teach on Edge School. There was a specific course actually about trading fair value gaps, but for me, that was for the members who want to focus on fair value gaps. For me, I only use fair value gaps for two different things. The first one is use it as a first target. That means if I'm looking for this specific level here for price to reach, okay, in the price action leg here, or the range from this point to the highest point here, for example, and I'm going short, for example, here or here. So let's say this one, because this is actually an edge model, the strategy that I teach. Now, if I'm going short here, mostly I want to look for this liquidity level and this key level that is below. However, in order to be safe and in order to stay on the safe side, I want to look for, first of all, fair value gaps to be filled. So I'm going to have, because fair value gaps can be, the first target you want to look for. So I'm going to enter here or here, and what I'm going to look for as my first target is for this fair value gap to be filled, and I'm going to take some partials here. This also apply to this imbalance here. So this imbalance is still unfilled. I'm going to look for this liquidity level and this imbalance to be filled before looking for any other key level. Now same thing here. If I enter here, and this is another edge model, now I enter here, okay, and then what is the first target I want to look for? Here is this fair value gap. So my first target is this imbalance, all right, maybe 50% of it, and then taking the rest. Now same thing, if I enter here, and that is another edge model, so entering here, what is my first target? I want to look for this imbalance first and then the other key level. So I do take it as the first target of my trade, because that is where a lot of time is going to have a reaction, and sometimes that is a reaction I don't want to see. I don't want to hold a trade after, and sometimes it's a reaction I want to take a partials after. Now another way of using the fair value gap is use it as key levels, and I want to see a reaction coming out of it. So for example, I want to look at this fair value gap and specifically 50%, and I want to use that as a key level. Now sometime we're going to have some key levels after testing that fair value gap. And this is something that I teach also. Now this is a reaction after testing the 50%. We can take this key level and we can actually trade off the 50%. So you're going to be using it, also aligning with concept number one, and you're going to see that you can blend the two, one as the key level and the other as confirmation entry, and you can go from there. So that is also another key level. So simply a key level that I can use here, fair value gap as a key level. I can enter here, I can enter here with a confirmation. So there are a lot of other uses for fair value gaps, but for me, the ones that I use is first of all as a target, and second as a key level. And you can see same thing here, fair value gap as a key level, and you can look for confirmation here. Here also another one, fair value gap as a key level, and then confirmation here going up. Concept number 4 is liquidity. Now liquidity in simple terms is an area in the chart where there are a lot of orders clustered, and most of the time it's going to be above highs and below lows. So when it comes to highs and lows, this is where most of the orders are being at. If you think about this high as an example, there are a lot of people who are putting stop losses above. There are people who are waiting for the breakout to happen above and then enter on the retest, as well as people having a stop order, buy stop above this level in order to go long when we have the breakout. So we have a lot of different types of orders above this high and at the high also. So when it comes to liquidity, again, it's an area where we have a lot of orders, but we can see it based on the pattern of price action. Now at these liquidity levels, we have two outcomes that are possible to happen. We could have a sweep and then reverse, so sweep and reverse. So in other words, we could have a sweep or displacement. We could have a reverse or continuation. That means when we displace above the high, a lot of times we're going to have a continuation. That means a break and retest. In other times, we're going to have a sweep, so failing to displace above. That means we fail to go above that high. We have a fake out only, and a fake out means there is an exhaustion. That means we cannot go above, and that means ultimately a reversal. So we could just reverse and go on the other side. I'm not going to go over liquidity on details here. There are a lot of other videos on my channel talking about liquidity in much details. This is just telling you about the concepts that I focus on as of now. Now, very similar to fair value gaps. So if you understand that market is fractal, you understand that liquidity and fair value gaps are very similar. Sometimes you're going to see the other in a lower time frame and the other one. So for example, fair value gap and liquidity. Sometimes when you switch to a lower time frame, you're going to see fair value gaps as liquidity levels, and the opposite is also true. But you know, they're very similar even when it comes to trading the concepts itself. So two ways also to trade liquidity, and very similar to fair value gaps. We can trade into liquidity. That means price is drawn toward the liquidity. And that means we have price going up, going up, going up, and we have a liquidity level here. We can enter here when we have a confirmation. So entry here into the other liquidity level. So we have the drawn into the liquidity level. The other way of trading is trading out of liquidity, which means reaction after the sweep. That means price is going up and we have a sweep, and we can enter here after the sweep happening. Now you want to use liquidity for entries and targets. So in simple words, you can actually use liquidity for entries and targets. Now, same as fair value gap also, liquidity can be a whole trading plan. So you can actually trade only based on liquidity levels. However, my main use of liquidity levels, now there are some people who want to enter and trade the liquidity level. There are people who want to look for fair value gap and sweep into fair value gap. There are people who want to, trade what happened after the sweep. So what happened after the sweep, giving you a valid structure to trade off. However, for me, now, this is validating key levels or point of interest. This is my main use of liquidity, because I don't mainly trade on liquidity levels, but I trade on different key levels. Now, I use liquidity to validate key levels. That means a key level is valid only if another level sits above or below. So above or below means for a bearish scenario, I want it to be below. For a bullish scenario, so we have a bullish scenario, I want it to be above. That means a key level above or below. And this another key level is actually the trap. I only trade the extreme level using the other one as liquidity. So when we have something like this, price is going down, creating an order block and another order block, one here and one here, or same thing, fair value gap here and fair value gap here. Which one you want to trade? You could trade both, and both could give you a reaction. However, if you want to switch from quantity to quality, you want to trade the extreme one, any extreme level. So when it comes to order blocks, when it comes to fair value gaps, when it comes to SNR levels, when it comes to Wicks, all of these things, you want to trade the extreme one and focus on it, because the other one will be liquidity. And if you're not trading the extreme one, then probably you're trading the liquidity. So in a bearish key level, you need another level below it, and that is a trap. For a bullish key level, you need another level above it, and that one is a trap. So you can actually apply this to any trading strategy, and you apply this to validate your key level, whatever it is. So applying this simple concept, if I take, for example, we have these two consecutive fair value gaps, and we have these two consecutive fair value gaps. You want to ask yourself, which one is an extreme one that is coming after a breakout structure, a main breakout structure, and a main, I would say, retracement. So we had this price action to the upside, and then we have a valid retracement, filling an imbalance, and then pushing to the upside, where we had this push to the upside, small retracement, and then another push to the upside, and then small retracement and a push to the upside. So you have multiple fair value gaps. But when you think about the extreme structure, we have this extreme fair value gaps after filling this range, and now price goes up, and then a very small retracement, which is not a significant one. Now you want to ask yourself, where do we have a fair value gap that has a fair value gap above or below? In this scenario, we have a bullish fair value gap that has another bullish fair value gaps above. That means this one becomes liquidity, and this one becomes a valid key level. All right, now this could be applicable here, only here. So if we only look for this one, because the market is fractal, sometimes you'll focus on this and you'll consider it as a high probability. You want to look at fair value gap above it. That means sometimes this fair value gap can be a liquidity, and this can be the valid one. Now another example is this key level here. You want to ask yourself a question: do we have another key level above it in order to consider it as a liquidity level? And yes, we do have this one. And these are liquidity levels, which can be used as, and you see it gave a reaction, but then eventually price goes lower to the extreme key level here going up. Now you want to also do the same thing here. Do we have a key level here? Yes, we do have this one, and it has liquidity here. There's also another key level here, and both of these key levels have a liquidity level here that can be used as a trap, and that is what happened. So if you notice, price takes this low, which is the liquidity level, going into here, and then we do have another key level here. I guess this one we have executed based on its goal, and then we do have this liquidity level. So this liquidity level and this key level becomes liquidity because we do have another one below that is the extreme one that we can take. So this one becomes liquidity and this one becomes valid, and that is what happened. You want to take this to supply demand, you want to take this to order block. Any strategy that you can use, you can actually look for this. In simple terms, if I have price going up, price coming lower, and then going lower, and we have a valid trading range, I would say, so something like this, where price started going lower, and we do have a key level here. It could be anything, and another key level here that could be anything. Price could come to this level and give a reaction. However, the main reaction and the valid key level would be this one. Why? Because this is now a liquidity for this one here, and this is going to be the valid key level that we should focus on. Concept number 3 is Wicks or SNR. Now this is the best way to start this concept, right? It's about the wicks, understanding the wicks and what do they mean in the chart. Now this is the euro dollar. This is the current price action of euro dollar. Now if you refer to the today's date and then look at this, you're gonna see this is what we have as of now. And I decided to take this in order to show you the importance of wicks and what they can do. Now you cannot just take any wick. Now this is what I teach on my mentorship. However, I want to show you how you can actually understand the wicks and the importance of them. Now, in short, wicks means reversal. And if you notice where price, looking at swing point is when we have this breakout structure and then price going lower into a valid key level, and then we have a big wick. What happened after? Big wick means reversal. And after this price going up, coming to a valid key level in this range, this is the wick, and that is price pushing higher. Now price was pushing higher into probably another key level here. What happened is we do have, if you notice, this is a wick, and what happened is price coming back to the wick and then going lower. Now same thing here, we create a wick, we start going lower. We create a wick, we start going up. We create a wick, and then you see immediately price going lower. And same thing here. Now sometime we're gonna have sweeps. All right, here if you notice, as price was going up, okay, going down and then going up here, what happened is price sweeping liquidity, going into a key level. But what is the signature here? What happened here is a creating of a big wick at a swing point where we think we could go lower, right? So what happened here, if you notice, creating a wick, this is where the body and the wick is, and if you notice, that is a snapper entry going lower, and that is what the edge model is. It's focusing on the wicks at a good key level. That's what we can trade. And if you notice, same thing here. Now this is another one, a key level, all right, or a wick, a strong wick here in a bullish market structure. This is could be a swing point, and you can take this wick in order to trade from here higher. So that is the importance of wick. And same thing here, we have a wick. A lot of time we're gonna fill that wick and then go lower. We have a wick, we're gonna fill that wick and then start going higher, right? And this is what happened. Now sometimes it's gonna give you a small reaction, even you can trade it on the lower time frame, and it's gonna still make you money. This is a wick. If you notice the size of this wick, that is what happened here. Price coming and filling that wick and then pushing lower. So you want to understand the wicks as a reversal signal. So that is the main premise, but in its school we use these wicks in order to find and get sniper entries same like this, and this is what I trade most of the time based on. So to keep it short, reversals start at the wick. This is where we could have actually a single wick that can flip the direction of the market, and you've seen that a lot of the times where I show you the examples. So what is the story inside of the wick? So when we have something like this where price is going up and at some point we have a wick and then price started going lower, this pattern of price going up and then going lower and then leaving a strong wick at the top here, what does that mean? What is the story inside of it? It actually shows you the battle between buyers and sellers. So if you notice, as price is going up, at some point it gets weaker and then boom, we have that strong wick. What does that mean? That is the battle and that is the end of it. So it reveals who won that fight. There was a fight when we were reaching a key level and then someone won that fight, either buyers or sellers. And that's why price respect them again and again. So as the example I showed you earlier, a lot of the time where we have a wick, price still goes back to that wick and then drop again. So that is my use of the wicks. So this is dollar yen, and this is a phase of price action where we actually took a lot of trades in the community all together. And I want to show you how to capitalize on these wicks when we have, you know, the understanding of market structure, which is actually the next concept. So if you understand market structure, you'll understand, you know, when we have a valid wick and we can trade based on. So if you notice here, we have a wick and then price was going lower, going up, you know, a reasonable retracement. This is a wick. If you notice here, a wick to the downside where we can actually trade. Now we do have another wick here that gives a reaction here. And we have, if we take this one here, so this is a wick, give a reaction. This is another wick that also give a reaction, and this is another wick that give a reaction to the lower side, and this is another wick that gave a reaction. And if I keep it like this, another wick that give a reaction. So if you notice, as price was coming lower into an imbalance, it created a wick, and then price came back to fill that wick. Now the understanding is when you have the wick, it means we have a potential reversal. The retest is price filling that wick, and price filling that wick is your opportunity to actually engage in that trend. Same thing here, if you notice, and if you notice here, so this is a wick, this means a reversal, price going higher, and this is the concept also of liquidity. So this is a wick above, this is a wick below. You want to trade the one below because this one is going to be the real one, and same here. So if you notice, we have a wick, a reversal to the lower side. We also have a wick here, we have a wick here. Now I'm gonna always focus on the extreme ones, but you notice how wicks actually, even here, now sometimes price is not gonna go back to them, yes, however they're still considered as reversal. Same thing here, if you notice, we have a wick after price going up, finding exhaustion. That means we have a wick means reversal, price goes lower, fill that wick partially, sometime, yeah, partially to the 50%, and then start going lower. So this is how we understand wicks. Wicks are key levels that we can actually find the most precise entries, and a lot of the refinement of fair value gaps, of order blocks, of supply and demand areas goes at the wicks. And this is my main focus when it comes to key levels, and this is what I teach my student to trade based on. Concept number 2, market structure. Now, in simple terms, and a lot of you already know market structure, but it is, I would say, 85% of the trades that I take, I always make sure I apply the concept of market structure in my trades. Now, what is market structure? It's simply the pattern of price movement over time. So we understand that price moves in either uptrend, which is price creating higher highs and higher lows as well. So price is going up, it's like a stair going up. We have downtrend, which is the opposite, which is price going lower and creating lower highs and lower lows. And sometimes we have sideways, which feels like price is only creating kind of equal highs and lows. So we're moving in the same, it feels like a flat floor, right? We're walking on the same area. We're not going up in the stair or going down. Now, the main purpose of structure is to define a range or a price action leg with the highest probability to trade from. So when you understand market structure, either a breakout structure or a market structure shift, which in other words, a continuation, or a reversal, which price was going down and then going up. When you understand this, It's about understanding and focusing on high probability ranges or price action legs to trade from. That's it. Now, my simple way of applying market structure is asking this question: what phase are we in right now? Are we in a continuation or reversal? In other words, expansion or pullback. The translation of this is, are we creating a higher high, lower high, higher low, or lower low? Because in market structure, we have 4 different possible scenarios. Either we're creating a higher high, higher low, or lower low. And the potential of it. Now, if I ask you, what are we creating here? Probably, what are we going to create? We do have breakout structure to the downside. That means we have a downtrend and prices pulling back there. What are we creating here? Based on these 4 different scenarios. Because this is a high and we have a breakout structure, this is a high probability range to trade from to the lower side. So what are we creating here? We're creating a high, same as this, but lower. So we are creating a lower high and then price going lower. Now for this one here, what we had is a breakout structure. That means we have now a valid range to trade off, a high probability one. This is a high. What are we probably creating here, or maybe here, or maybe here? So at some point after this move done here and finished, what are we creating after? We are creating a low that is lower. So we're creating a lower low in order to push higher. So you can actually trade this one. And this one is going to be what? So catching this low is going to be the reversal. It's going to be catching the pullback. But here, because we do have this valid range with a trend, catching this lower high is actually catching the expansion, which is catching the continuation. So that is the main difference here. And that is how you understand it. Now, sometime we're going to have this sweep and then market such a shift. It gives you another range to trade off. And then when price goes lower, you can catch the higher low here in order to push to the upside. That is my simple way to understand market structure. So it's simply applying 2 things: asking this question and then finding your high probability range. That's it. So when it comes to understanding market structure and asking that question, you want to always ask, so price is going lower. What are we creating here? What are we creating here? Potentially, what could we be creating here? That is the main question. But also, you want to look for the signature of breakout structure or a market structure shift in order to trade. So if you notice here, as an example, price was going lower, going up, going lower. And then at some point, we started going up and breaking structure here. That means we went from a continuation to a breakout structure here. So we broke multiple resistance levels and multiple swing points. So now we could be actually moving to the upside, and we create a fair value gap here, which could be an entry, and we create a wick here, which is a perfect edge model here to trade off, and you catch this with a very small stop loss to the upside. So now you understand that the structure is bullish and you want to trade this bullish structure. Now we have this low to this high. That is a valid range to look for buys from. And then we have another range to look for buys from, which is from this low after this breakout structure and then to this high. So from here to here, I'll be looking for buys. And now you can actually apply a Fibonacci or SNR levels or fair value gaps, and you want to look for entries around here. Why? Because now you have a valid range from here to here. And then same thing, now we have a breakout structure. Sometimes you can focus on the internal ones, sometimes on the external ones. Now we have another breakout structure here of this main range. So now we can also apply Fibonacci again. And after this strong move to the upside, this is the external range, the main range. And sometimes you have these small ranges inside, which you can also trade. We have a breakout structure, pulling back, price going up. A breakout structure, pulling back, price going up. And then we have also this internal structure, price going lower. You can trade from these imbalances, but the main range is here from this low to this high, and then price pulls back lower into a key level and then going higher. So this is how you understand market structure, and you always ask yourself that question, that important question: what are we creating right now? What phase are we in? Now, concept number one, time frame alignment. Now, after 7 years of trading, if you ask me about the most important and significant lesson and the most important concepts that you can actually apply to your trading strategy or to your trading in general, it would be this one. I did make a video about this 2 weeks ago. This is the video. I really recommend watching it. So every trading strategy fails without this rule, and I really mean this. Now, this single concept actually turns any strategy, no matter how simple, no matter how silly it can be, into a real edge. And when you apply this, the time frame alignment, it actually gives you automatic direction. It can give you higher reward to risk. It gives you higher win rate. And then you focus more on quality trades other than quantity. So time frame alignment means higher probability. And how do you do that? You align lower time frame with higher time frame. You have two time frames, and they need to be relative, one that is relatively higher to the other and one that is relatively lower to the other. So two time frames, one is lower, another is higher. When both point the same way, that means trades have more weight and they're higher probability, and they have the tendency to work more than if we just trade based on one time frame. That is simply what time frame alignment is. Now, in simple way, we're going to use higher time frame and a lower time frame, one for direction, another for entry. And these are the time frame that you can use. For higher time frame, these are the ones. For lower time frame, these are the ones. If you go with daily as your high time frame, you can use your hourly as your low time frame. That means if you use daily for your direction, for your key level, you use hourly for your lower time frame. That means for your entry. Now, in simple terms, time frame alignment, as I said, is having the alignment, in other words, matching two time frames on the same bias, on the same direction, and then taking the trade. That means if we look and apply the higher time frame to our time frame here, we have a higher time frame key level, and then this is the lower time frame details and the lower time frame price action. When price comes to that level, to the zone here on the higher time frame, I want to look for the alignment on the lower time frame. That means because this is a bullish higher time frame level, I want to see the lower time frame to flip bullish, which can happen here or can happen here, depending on your trading strategy. So any signal that tells you that now the lower time frame is becoming bullish, that is the alignment. So if, for example, the safest one would be a breakout structure or a market structure shift, we have it here. And then what happened is now we are flipping bullish. We take an entry here because at this point, when we have this breakout structure, that is the higher time frame is already bullish because it's a bullish key level. Now the lower time frame is also becoming bullish. That means we have an alignment, and then we can take long position here with a high reward to risk. Why? Because we're taking a trade on the lower time frame that is actually based on the direction and the key levels of the higher time frame. In other words, we can take an entry on the lower time frame, but then target some higher time frame key levels, maybe here. And if you notice, you're taking this big move here from a higher time frame key level to another higher time frame key level. That is, how I see trading. It's a move from a key level to another. If I can capitalize on this and take advantage and trade based on the lower time frame, that is where I can actually focus on high probability trades and higher reward to risk trades as well. So as an example of time frame alignment, we're using 4 hour here. You want to look for any key level. So I don't know, any key level. For example, this imbalance, when price comes back to it, I want to switch to 15-minute time frame or 5 minute, and I want to see any signal of time frame alignment here. So as an example, a break of structure, and then I'll take my trade, or an engulfing candle. Now, if we focus on a real example here, one that I was actually watching with my members, which is this one here, this key level. Now, this is a wick, that means a reversal, and then price comes back to that wick. Now, when price comes back to that wick, let's imagine that we're only focusing on 4 hour here. Now price goes to that key level, and then after that it gives you a bearish candle, and then it gives you another bearish candle. There is no engulfing candle to enter here. But even if you were enter based on this bearish candle, stop loss goes above the high, slightly above, and then you target, for example, the other key level, which this as a liquidity, and this is your other key level here based on the edge model. Now you can catch this 3-to-1, right? So you caught 3-to-1 only if you enter based on this, because sometimes you could be entering on an imbalance, which you get your entry here and your stop loss above. So 2-to-1. So let's say 2 to 3-to-1 or 2 to 3.5-to-1. However, if we use a time frame alignment here, go to 15-minute time frame, and then notice what happened when price goes back to that key level that you marked. Now you could be using any different tab of entry, any confirmation entry. This is your higher time frame entry, right? So it's around here. We take it to the right, around here. However, if we look at this one here, and then we notice that price goes back to retest this level and then gives you a huge engulfing candle. If we were to enter off this engulfing candle, sometime the edge model would be here, not filled, all right? But let's say we take an entry based on this engulfing candle. Stop loss goes above it. So we're doing the same thing as the high time frame. This is the high, slightly above it, randomly. And now what we target is the same key level, because now we're trading the lower time frame, but based on the levels or the key levels of the high time frame. So we have the same logic here. And then this is your trade. Now, do you notice the difference between these two trades? This one gives you 3-to-1. What does that mean? That means if you're risking $100, you made $300 or $350. However, this one, it gives you 11-to-1. That means, let's consider a 10-to-1, for example. That means if you're risking $100, which is same amount that you're risking here, where you made $350 here you're making $1,000. So that's a lot more than this one, almost, triple the amount, 3 times the amount. And that is the significance and importance of time frame alignment. It gives you more profit as well as higher win rate. Now, same logic to any different key level. As an example, this imbalance. If you want to take this imbalance and then look at 50%, or look at, let me take one that is more clear, or even this level here. This is another edge model. If I take this one and then say that I'll be trading this one to the higher time frame to the next level. So your next level, the most safe one would be taking this high, all right? And then the one after is this key level here. Now I will be trading from here to here. So let's take this as target one. Now, most of the time with the no time frame alignment, you'll enter, some people would enter after breaking above this high, some people with this, some people with the engulfing candle. But let's take the best case scenario, which is you entering when price break above this or at the closure of it. And then this is the low, stop loss goes below, okay? So below the low, and then your first target is here. That is a 3.3. However, if we use time frame alignment here and look at the 50-minute time frame, and you want to look for the alignment, if you notice, we have price going lower. And if we take the same confirmation we've took on the higher time frame, which is just price closing above out of the trade. Now this is your comparison here. This is a 12-to-1. However, not everyone is going to take this candle. Now, when do we have a breakout structure? As an example, your breakout structure, we have this main level here where we broke above, and then you want to look for confirmation here. Now, yeah, sometimes it's going to be confusing. We don't have this edge model here. It's confusing here. Maybe on the hourly, if we have an engulfing candle, we can take, all right? But it's about, the difference between, even considering this big rejection candle and then this small candle to the upside. Rejection mean we have, reversal. So we can take it based on the reversal candle here and the stop loss below it. And even this one gives you much more, gives you almost double this one, not double, yeah, around the double. So this is the importance of time frame alignment. I'm not telling you that every time you will have valid entry. However, if you focus on and only execute when you have the valid confirmation, you're gonna make much more money than just trading based on one time frame. And this is not only applicable on the 4-hour, but even on 15-minute. If I take just any key level on the 15-minute, or if I take the same key level on the 15-minute and now blend it with, doing the same thing and then maybe targeting this level here. But I will take this based on the 1-minute confirmation, and that is the difference. So here I want to look for market structure shift, which I can see as an example here, taking the high and then taking the low and then taking, any entry from here. Okay, so based on Fibonacci or anything, let's say randomly, I'm going to take it from here. Okay, and then stop loss above. Targeting this level, look at how much reward to risk this can be, even if I take it lower, compared to if I go to 15-minute time frame. So your entry was here, compared to 15-minute. If I were to take this one and then, so this is the lower time frame confirmation, this is your 15-minute engulfing candle, and then stops above, and then this is your entry. You see, this lower time frame confirmation always gives you more reward to risk, and eventually it's going to give you also higher win rate a lot of the times, because you focus on confirmation. You want to look for a reaction of that level. That is what top-down analysis is and what time frame alignment is actually. So that's the end of the video. Make sure to check out Edge School, where we have different courses and different workshops, as well as these are some of the trades that we take using the Edge model. So if you want to learn about my specific trading strategy, you are free to join the community and the mentorship. Make sure to also share the video with your friends, leave a comment and a like to the video, and I will see you in the next one.